Welcome to the B.F. Anderson Technical Report for July the 8th. Warren Buffett, another quote here, I have probably purchased 50 hot tips in my career, maybe even more. When I put them all together, I know I am a net loser. The message here is don't take tips. You've got to do your research. You've got to understand what you're investing in. And I would say the most important concept in stock selection is you've got to be consistent. You have to have a consistent strategy that can repeat over and over again. Buffett goes on to say risk comes from not knowing what you're doing. So when you sit there and watch TV all day or you get on the internet and you get tips, it's just not going to work. So let's go ahead and look at the market. Here we have the NASDAQ. As you can see, we're continuing to make new highs on the NASDAQ. Very constructive pattern. Technology is pretty much leading the way here. Now, as we get into the mid caps, you can see what I'm saying. We're kind of getting a little bit of a breakdown on the mid cap stocks. They're really not participating. The problem here is the market is really not broadening out. We would like to see all the indexes making new highs. Here's the New York Composite, same things. Particular index is pretty much just moving sideways. Here we have the small caps actually rolling over, breaking below the 50-day moving average. Again, the market is not broadening out. This is pretty much technology is driving the market at this point. Now, here's the large caps, the S&P 500. Again, you can see new highs, just like the NASDAQ. So the market's becoming very focused in just a certain group of stocks. Be aware of this. It's not a good sign. However, you can still make money. Now, on the weekly basis, you can see here on the trend lines, the NASDAQ, very constructive, no problem. S&P 500, very constructive, no problem. So on our trend lines indicator, we're in really good shape. On the aggression index, we've got a peak back in February, a drop, a further drop, held the 40-week moving average, and is now starting to rally. This is because the technology stocks are taking somewhat of a leadership position. Now, the most interesting thing this week for me is the fact that interest rates are continuing to drop. We are at 1.32 on the 10-year Treasury. Now, remember, it wasn't too long ago, we were above 1.7, and everyone was screaming, inflation is coming, inflation is coming. The market is not discounting inflation, and if anything, looking at what I'm looking at, we could be looking at an economic slowdown and maybe a deflationary period. Now you can see here oil kind of being a strong uptrend, kind of pulling back a little bit. Financial stocks going with interest rates, kind of consolidating, but not making new highs. The new lows, no problem. We're in good shape there. We're below 40 a day, continues to be strong. This is a bull market. Now on the inverted yield curve, no inversion. We're just seeing interest rates starting to drop here, and we're starting to see a flattening out of the yield curve. Nothing to be concerned about at this point, but if we get an inversion, I would be concerned. Now, on the bull-bear ratio on AAII, we're back up in kind of a hefty area, kind of a frothy area. It just continues to tell us just to be on your toes here. Now, on the put-call ratio, same thing. We're seeing what the mutual funds and the big funds are all buying calls instead of puts, driving it into a greed sector. Continue to be aware of this. But don't take, this is a secondary indicator. Do not take primary action based on sentiment, but it's something to be aware of. Now, here's what is really interesting. This is the TIP bonds, which is the inflation-protected bonds, versus the traditional treasury bonds. You can see for a long period of time, the market's been concerned about inflation, inflation, inflation. All of a sudden, we get a peak, we get a low, we get a lower peak, get a lower low, we get a peak, we get a lower low. Now we're starting to see it turn down again. The market is not worried about inflation, so kind of get that in your noggin. Now, on the Russell 2000 Growth ETF, you can see it's somewhat breaking down here. Now, realize a lot of these small cap stocks are financial stocks, meaning small banks. That could be driving this. I added this particular indicator as a way just to kind of keep track of the small cap growth stocks. We'll just have to see. We're watching it. Now, again, I mentioned that I'm concerned about economic slowdown. Here we've got the junk bonds versus the traditional treasury bond. We're seeing somewhat of a rollover here. This is not a positive sign. However, that might be why interest rates are heading lower, because the market's more concerned about economic slowdown than economic expansion, which means inflation. Volatility index continues the very constructive pattern here. We're in good shape there. Now, I wanted to mention a couple of stocks here. Here's Apple. Look at this thing. It's breaking out. Now, this is the king daddy of the technology stocks. The technology stocks have caught fire here. Apple is somewhat of a bellwether. You can see the strength in the stock looks very positive. Now, I wanted to also point out, we're all talking about recently oil stocks, and we're going to see some more oil stocks still in the top 5. But I want to talk about commodities as a general thing. Now, I took a period of time just to make a point. Commodities can be a very difficult place to invest. So from 1989 to 2000, the CRB index, which is an index of commodity stocks and commodity prices, dropped 16% between 1989 and 2000. So you could be distracted and fooling with commodities, but then in the meantime, the S&P 500 over the same time period went up 450%. So commodities went down 16%. The market went up 450%. Commodities can be a tremendous waste of time. You just have to be careful about them. Now, here are the top 5. Here's the software stocks are hot. They're doing real well. This is a company called Asana, mainly management software. Now, one thing that's a continuing theme with most software stocks today is they're all on a subscription basis. Like, for example, our firm uses a software called Advent. We couldn't live without it. We pay about $2,000 a month for this right to use this software. It's a subscription-based service. All these companies are going to that. So if you're a corporation or an individual using a particular software and you become dependent on it, well, it's almost like an electric utility or a gas utility. You're going to pay that monthly subscription every month. It's kind of a sweet business, to be frank. Here's Continental Resources. Again, this is oil and gas. You can see the breakdown. We're seeing somewhat of a breakdown here. I would continue to avoid this group. Callon Petroleum, same thing. We're getting the breakdown. We try to make money in these oil stocks. They're just too hard to predict. So in other words, you got to worry about the stock, and then you have to worry about the price of the commodity. And if the price of the commodity doesn't behave itself, you're going to have a problem. How do you predict that? Here's Hubspot, one of these subscription-based softwares. This is a CRM software, which is customer relation management. A lot of people use these softwares, can't live without them. Here's NVIDIA. Now, this is hardware. This is a company that's involved. We own HubSpot. We also own NVIDIA. NVIDIA has very high-end optical processors, which means that if you've got a camera on a car and it's processing video data coming into that car for an autonomous purpose, this is the technology everybody's going to. So basically, keep an eye on NVIDIA. We own the stock. We think it's going higher. We think it could be the next Apple, but who knows? Anyway, that's it. Let me know if you have any questions. Thank you very much.